Hey everybody, if you're invested in the cryptocurrency space, this is a really important video. We've heard a lot about the concerns and risks around stablecoins and the rehypothecation problem. But let's take a look into a recent announcement we've just had from USDC. So they're founded by a group called Circle, and they've just released an update to say that Circle reverts to more conservative investment profile for UST reserves. Now, if we go back to July, we had this. Circle, over 60% of USDC backed by cash and cash equivalents. So to add some context, USDC is the second largest stablecoin after USDT, which is also known as Tether. Tether is sitting at about 65 billion roughly of market cap, and USDC is at about 27 billion. So substantially smaller, but they're growing far quicker. They grew at 600% over this year so far, which is 3 times quicker than USDT. Now, Circle founded this with Coinbase, so Coinbase have an interest in this as well. And what they've announced, well, in July they were saying that over 60% is backed by cash and cash equivalents. Whereas now they've moved to say that they're changing their investment profile. And we'll touch on this in just a little while. But the first thing we need to understand is the following. When we started off with stablecoins, we were under the impression, early investors, that these stablecoins would back 1-for-1 to the US dollar. So for every one stablecoin they mint, which is a USDT or USDC, they would keep $1 in their reserves. What we have since found out since these reports and these audits and more things have been going through in terms of regulation, and more is going to come through. We've heard that from Gary Gensler and Jerome Powell spoken about it too. We're finding out that this is not actually the case, and these companies, whether it's Tether or Circle for USDC, are not holding $1-to-$1. So the article that came out in July showed that they had 60% of cash equivalents. Now, clearly the market didn't react well to that, and that's why now they've changed theirs to say that we're going to peg to just US Treasuries, short-term US Treasuries and cash. So they're saying that if we are to have 27.3 billion in circulating supply, we've minted 27.3 billion USDC, we'll have 27.3 worth of cash or short-term US bonds on our balance sheet. Now, this is probably the best circumstance we could hope for at this current stage. I mean, ideal would be just to have all cash, but for their reasons, they want to invest it and put it into treasuries, which we can argue. But this is still substantial progress from what it was before. So before they announced this, what their situation was in their last report was they had 61% backed in cash-related assets, which even not, cash-related assets, so it's deemed cash by accountants. They had 13% in Yankee CDs, which aren't necessarily the safest. You got 12% in deemed risk-free US Treasuries, 9% in commercial paper, and then they had 5% in corporate bonds, which is risky to even think that they're putting some of this in corporate bonds is where markets get spooked and we start to think about the rehypothecation problem. Can't speak. So this is an interesting step. I mean, let's just take a look at where Tether is sitting at. So Tether, 49%, this is of their latest report, 49% of Tether's reserves was held in commercial paper or certificate of deposit, CDs, of which 93% was rated A2 and above 1.5% below. Okay, then they had about 10% in cash and bank deposits, so 6.28 billion for them. They had some repo notes, and they had 24% in US Treasury bills. Okay, so this is definitely a move by Circle to have a more transparent and a bit more safer makeup, which should bode well for the stablecoin market. But this is one of the places where I'm pro-regulation. I'd love to see some regulation come into here and really solve this problem. We need to have some sort of auditing process where it's done regularly so that we can have confidence that the amount they're minting is not outgrowing what they have as cash equivalents. I'd also want to see at least some sort of a percentage, similar to how with the banking you have in fractional reserve banking. People say, look, why are you worried in crypto? You have this in fractional reserve banking. You have Basel 1 and 2 regulations where banks are are stipulated legally to hold a certain percent in on their balance sheet of cash. And now we want to see the same for these stablecoin providers. And this is an important step we'll need, because it's things like this which, if it gets out of hand, can really put the cryptocurrency market in disrepute. So this is a really welcome step, and a good piece of news that USDC are taking this step. The next step is to have it in just cash. We'd love to have that. Whether that'll happen, whether that's realistic, we're not too sure. But to have it in cash and US dollar treasuries and remove all these Yankee CDs, commercial papers, and God forbid, corporate junk bonds, that's definitely a step forward. All right, see you in the next one.